All right, everybody, I am back with a brand new update. And this is going to be Warner Brothers Discovery centric because there was an article by The Wrap yesterday in regards to Warner Brothers Discovery and also the quarter two earnings. Or was it quarter three? I can't remember. Their earnings report, either way, their earnings report came out today. And we're going to look at what people are saying about the earnings report. And I'm telling you right now, Warner Brothers Discovery is burning to the ground. In fact, their stock hit historic lows today. And we're going to take a look at some stuff. And I know some of you have been waiting for me to do a Warner Brothers Discovery video, and I've been waiting for something to pop. And this was enough information to be able to finally do a video, because it was planned that Warner Brothers Discovery was going to basically sell off some of their assets like CNN and some of the other stuff. We already know they got rid of the NBA. They gave them the hike. And we're going to see how much money Warner Brothers lost. So they're no longer digging themselves out of debt, guys. They actually got further in debt. And it's crazy. So let's take a look at these couple of articles here. So first up is from The Wrap. It says, Warner Brothers Discovery looks to pursue smaller asset sales after mulling possible breakup report. The media giant reportedly determined a split of streaming and studio businesses from linear could create operational challenges. After mulling a possible breakup, Warner Brothers Discovery executives are now looking to pursue smaller asset sales instead, according to the Financial Times. The outlet noted that the David Zaslav-led media giant has been evaluating all options as its stock price has declined 67% since the April 2022 merger. However, senior management reportedly determined that splitting its linear networks and some or all of its roughly $39 billion in debt from its streaming and studio businesses would create very significant operational challenges and could trigger lawsuits from the company's debt investors. That's the key right there. So it really has nothing to do with the operational challenges. It has to do with the fact that they were going to get sued by their investors. Sources told the Financial Times that the split was viewed as a potential nuclear option. It goes on to say instead the company is reportedly looking at selling smaller assets such as Polish broadcaster TVN or a stake in Warner Brothers Discovery's video game division. However, it appears to be stopping short of selling CNN, with a source telling Financial Times that the bar for divesting the news network would be very, very high because of its strategic importance as well as a deal's tax implications. Bank of America has previously estimated that CNN could be worth $6 billion if potentially spun off, while Warner Brothers Games could be worth $5.6 billion and Poland's TVN could be worth $3.5 billion. A spokesperson for Warner Brothers Discovery declined to comment. The reported move away from a possible breakup comes as Warner Brothers Discovery has been cutting costs through other means, such as layoffs, content write-offs, and selling off smaller assets like All3 Media, as it looks to reduce its debt and turn the company around. Which really isn't helping, guys. There are reports out there. So if you guys have been on social media, you will have noticed today that all over the world it has been trending of don't stream on Max, because they have been coming in and telling the creatives to cut seasons down, cut budgets. They're creating nothing but havoc for the creatives out there. Goes on to say, Citigroup analyst Jason Bazinet has estimated that a split-up firm could be worth $67.2 billion, or roughly $11 per share. He believes the network business could be worth $42.5 billion and the studio and direct-to-consumer business worth $24.7 billion. According to the Financial Times, Warner's management team believes a turned-around company's true market capitalization could be $60 billion or $25 per share. Shares of Warner Brothers Discovery fell 2% during Tuesday's trading session, with its market capitalization sitting at $19.13 billion. On Wednesday, Warner Brothers Discovery will report its earnings for the second quarter of 2024. Let's take a look at that report, which just got released today. This is from Variety. It says, Warner Brothers Discovery stock crumples to a near all-time low after huge quarter 2 impairment charge. It says here, shares of Warner Brothers Discovery slid nearly 10% Wednesday, nearing all-time lows after the media conglomerate, heavily reliant on its pay TV business, recorded a whopping $9.1 billion write-down, reflecting the loss of value of several of its linear television networks. In after-hours trading, Warner Brothers Discovery shares were down as low as $6.96 per share. The stock's lowest closing price was on June 18th of 2024, when it ended the day at $6.99 per share. Its 52 low intraday price is $6.94. Year to date, Warner Brothers Discovery shares were already down 34%. As of the close of trading Wednesday, Warner Brothers Discovery's market capitalization stood at $18.8 billion, compared with more than $50 billion following the closings of Discovery's acquisition of Warner Media in April of 2022. When companies are forced to write down goodwill, an amount above the fair market value of an asset, they reduce that value from their balance sheet and record an expense on their income statement for the loss. Such a move reflects management's acknowledgement that initial projections for investments or acquisitions fell well short of projections. Warner Brothers Discovery said the triggering events for the goodwill impairment of its TV networks were uncertainty about NBA rights, which the company is poised to lose starting with the 2025 season, as well as continued softness in the linear ad market. The cratering stock, the disappointing quarter 2 earnings, the massive debt load, and the company's loss of the NBA will put more pressure on CEO David Zaslav to find a strategy, and fast, to right the ship. In light of industry headwinds, we have and will continue taking bold steps like reimagining our existing linear partnerships and pursuing new bundling opportunities, with the goal to get Max on the devices of more consumers faster and at a fraction of the acquisition cost, Zaslav said in prepared remarks about the quarter 2 earnings. Last month, Warner Brothers Discovery laid off almost 1,000 employees in a new bid to pare down costs. There could be an M&A event on Warner Brothers Discovery's horizon, similar to the deal Skydance Media negotiated, that would see it merge with Paramount Global, which also operates a business weighted towards TV. Zaslav, speaking at an investment conference this spring, said Warner Brothers Discovery will be opportunistic in seeking M&A deals in the next 2 or 3 years. There are a lot of players that are losing a lot of money, he said. There'll be some players that want to get out of the business, that will look to consolidate their streaming businesses with others. I find it funny that he's looking for others to fail when his business is failing. At Allen & Co.'s retreatment last month in Sun Valley, Idaho, Zaslav said he was in favor of whichever presidential candidate could cut through government red tape and ease the way for M&A. We just need an opportunity for deregulation so companies can consolidate and do what we need to be even better, he said. It amazes me that David Zaslav does not see that his company is failing. I saw another report today where it talked about the quarter 2, and they did lose $7 billion. $7 billion. And the only place where they really made money is in the box office, which was up 19% versus the previous year. And also with HBO Max. Well, Max. They have more subscribers on Max. But those earnings didn't equal billions of dollars. They equaled hundreds of millions of dollars. And so they lost $10 billion. So you got to add that to their already existing debt. Their stock is falling, and investors are not happy. Something is going to pop. And I don't think they're going to be able to wait until Superman comes out. They're hoping that they can make Superman this big hit and try to sell it to another company to want to acquire Warner Brothers movie franchise, just the movie division. Zaslav never really wanted it in the first place. He just wanted to turn it to try and make a buck. But in fact, he's running everything into the ground. There have been some good movies that have been released, but they would have to have, I can't remember exactly how much in debt they are. It's a ridiculous number. And they would need so many Barbie movies just to even get them out of debt. And unfortunately, none of the movies are making the kind of money that Barbie did. They've had a couple of good movies, but nothing that is going to get them out of the billions of dollars, tens of billions of dollars that they are in debt. And this just added to it. So investors, the bottom line is investors are not happy, and Warner Brothers Discovery is burning to the ground. And all it's doing is it's causing them to cut budgets for the creatives and having them shut, not shut, but cut corners in efforts to make seasons shorter and get things through the door. It's not going to happen, guys. Things are not looking good for Warner Brothers Discovery. Something is going to happen. They're either going to get swallowed up or they're going to have to be forced to sell. Their investors are not going to be okay with this. What are your guys' thoughts on Warner Brothers Discovery? We will see you on the next video.